The idea of inflation eroding my money scared me a lot. So I've always made sure to invest throughout my life. As a result, not only did I beat inflation, but my investments now grow by around $17,000 every week on their own. This has made me millions over my lifetime. I'm not a financial advisor, but I've been through it, and that's why I'm making this video. So, how can you make money by investing in stocks? Well, first, let's tackle the inflation issue. Over the last 60 years, inflation has averaged about 3.8% per year. If your money isn't growing faster than this, you're essentially losing purchasing power. In a perfect world, you'd have a savings account that consistently gives you an average return of 8% to 10% each year. That way, you could beat inflation and make some profit. Unfortunately, such savings accounts don't exist. However, you can achieve returns like this by investing in the stock market. When you buy a stock, you're essentially buying a small piece of a company. This makes you a shareholder. And as a shareholder, there are two ways you can make money. Firstly, if the stock's price goes up while you own it, you can sell it for a profit. Secondly, you might receive dividends. These are regular payments to shareholders. Not all stocks pay them, but if they do, you can earn money without selling your stock. The real magic happens when you own several stocks that grow by an average of 10% each year. This is where compound interest comes into play. Compound interest makes your money grow faster over time. It's like a financial superpower.
Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys.
Let's try an example. If you could invest $250 every month and get an 8% annual return, in 42 years, you'd be a millionaire. Keep doing it for another 10 years, and you'd have over 2 million. Of course, if you could invest even more, you'd reach your goals even faster. This is all based on historical data and not guaranteed, but it's a strategy that has worked for many. Now, when should you start investing? The short answer: as soon as possible. The younger you start, the better. This gives your investments more time to grow and compound. Plus, you can take more risks because you have time to recover from any market crashes. And crashes do happen, but that's just part of the investing journey. Here's a simple plan to get you started. First, pay off high-interest debts like credit cards. It doesn't make sense to aim for a 10% return in the stock market when you are paying 15% to a credit card company. Second, build an emergency fund. This should cover 3 to 6 months of your living expenses. It acts as a financial safety net so that you don't have to sell your investments in case of unexpected expenses. Once you've handled these steps, you're ready to start investing. If you're under 18, you can ask a parent to open a custodial account for you. This can give you a head start on your financial journey. Now, you might be wondering, how much should I invest? Well, some investors will tell you to invest as much as you can, but I have a different perspective. I made most of my money by starting businesses and used the stock market to grow my wealth gradually. I've also enjoyed life by doing things like flying planes, racing cars, and traveling the world. If I had put all my money into stocks, I would have missed out on these experiences. So, my advice is to invest an amount you are comfortable with. However, if you want a more structured approach, consider the 70/20/10 rule. Allocate 70% of your money to cover living expenses, put 20% into investments, and reserve 10% for fun activities. Studies have shown that people who follow this rule are better equipped to handle life's financial challenges and get ahead of the game. It strikes a balance between building wealth and enjoying life along the way. All right. Let's dive into picking the best stocks. So, you might be wondering, how do I choose the right stocks? Well, there are mainly two ways to try to predict the stock market: technical and fundamental analysis. Think of it like a scale. Short-term day traders usually focus on the technical stuff. They examine charts and patterns, believing they can predict price changes by analyzing the highs and lows on those graphs. As a long-term investor, I prefer to keep it simple. While some people talk about using margin and options, that's not my concern. I'm more interested in a company's fundamentals. That includes its financial health, leadership quality, and brand recognition. I believe these factors reveal a stock's long-term potential. When I invest in a stock, I don't plan to sell it for at least 2 to 5 years. However, I still keep an eye on charts occasionally to find the best buying opportunities. This approach has helped me discover some excellent investments over the years, rather than constantly trading to make a quick profit. But here's the thing. Most of my investments aren't like that at all. That's because I put most of my money into index funds, which is a fantastic strategy for most people. Now, what's an index fund? Think of it as a way for regular folks to make money just as effectively as the professionals, with minimal effort. If you've followed sports, you'll know about league tables, right? The better a team performs, the higher it ranks, and if they do poorly, they might get booted from the league. Well, an index is pretty much the same, but instead of teams, you have companies. Take the S&P 500, for example. It's a list of about 500 of the largest public companies in the USA, with big players like Amazon, Google, Apple, and Tesla. Similar to a sports league table, if a company in the index does badly, it might get dropped. Now, instead of picking individual companies to invest in, which can be risky if they stumble, an index fund lets you invest in every company on that list with a single click. It's like a sneaky way to spread your investments across the board. Simple, right? Here's the deal. Even if a few companies in an index fund perform poorly, it's balanced out by all the other companies doing really well. For instance, the S&P 500, which includes around 500 big US companies, has had an average annual return of 13.6% over the last decade. While this is a bit higher than the long-term average, no one has ever lost money if they've stuck with an S&P 500 index fund for more than 20 years. Now, here's a little secret. On average, actively managed funds, the ones run by financial pros, tend to earn 2% less per year than the overall market. So, pros often do worse than index funds. Plus, they still charge you high fees, whether they make you money or not. The cool thing about index funds is they can charge super low fees, sometimes as low as 0.02% per year. Why? Because they're hands-off. They basically take care of themselves and don't need a pro making constant adjustments. When I tell people about index funds, it usually blows their minds. But here's the kicker. When they open an investing app, they often get overwhelmed by all the options and ask, which index fund should I go for? First, there's the one that tracks the S&P 500. We mentioned this earlier. Its historical return of 8 to 10% is thanks to the magic of compound interest. The S&P 500 includes 11 different industries or sectors, and no single sector makes up more than 30% of the index. Although these days, it's pretty tech-heavy, with 5 tech giants making up 23% of the whole fund. Whether that's a good thing or not depends on your belief in the future of technology. Imagine you want to invest in something, say a stock, and it costs $500 per share. With regular stocks, you have to pay the whole $500 to buy one share. Now, ETFs, exchange-traded funds, are a bit different. You can buy a piece of a share, like $10 worth instead of the whole thing. This can be super handy if you're just getting started or want to invest a bit of money regularly. For example, I set up a direct deposit from my bank account every month, so I'm constantly investing without even thinking about it. Honestly, there's not a huge difference between an index fund and an ETF. You just need to think about which one suits you best and go for it. Next up, let's talk about the second type of index fund, the total stock market index. This one has been giving investors an average of 13% return each year for the past decade. It's like the ultimate diversification because it covers everything in the market. If you want to invest for the long haul without checking it constantly, this could be your go-to. When you invest in everything, you're spreading your bets across the whole market. So unless something crazy happens, and it does sometimes, you should be okay. Even if there's a crash, history shows that things tend to bounce back. I've seen 3 crashes in my time as an investor: the dot-com bubble, the 2008 financial crisis, and the 2020 COVID crash. They stung, but in the long run, the markets recovered. But there's a little downside. Since it covers everything, it might not give you all the gains from a single stock that's shooting for the moon. If you believe in a specific stock, investing in a total market index might not let you fully cash in on that one stock's success. Now, let's move on to the third type, the emerging markets index. Some experts think emerging markets are on the upswing, and whether I agree or not, I figure it's smart to have at least a little skin in that game. Sure, investing in big names like the S&P 500 is great, but what if a place like China has some major gains? you'd miss out. For example, 20 years ago, I thought about buying a place in Shenzhen, China, for $47,000. Now it's worth over $1 million. That's some serious growth potential right there. Emerging market funds are riskier than the others we've talked about because they include stocks from lots of different up-and-coming markets, often with a bunch of Chinese companies. When you look at the list of the world's biggest economies, you'll see that many of them are emerging markets. So, it makes sense to throw a bit of money into these for diversification. Is investing risky? Honestly, I don't recommend this too much. The best way to make your investments work for you is to let them grow as long as possible. So, the golden rule is this: invest and forget about it until you are ready to stop investing and enjoy your profits. That way, you avoid making rash decisions out of fear.